All right, good morning, everyone. Welcome to today's webinar. Benjamin here speaking. We're kicking off the presentation with a take on the SGX results released last week. And then following that, Kenneth will take you through the initiation of Civmec. Right, so this is an update on the SGX results released last week. So the week before that, we gave an estimation on the upcoming results. So as expected, the 1Q net profit came in about 77.6 mil. Total top line is 168.9 mil. So it was down quite a bit year on year. Q on Q wise was largely flat. Alright, so total revenue and operating profit was in line for expectations, but there was a bit of a tax write-back last quarter. So I think some of the key things we'd like to highlight after the results season is also the impact of the average clearing fees that was revised as of 1st of June last year. So previously, the clearing fees were structured slightly differently. So currently, it's been changed to a flat 3.25 basis points per trade. Going from the 1st of June onwards, and so the cap of $600 for any contract value above 1.5 mil has been revised. So from what we have seen, the average clearing fees is 3.1 basis points, so it's slightly lower than 3.25. Right, so this shows that the market makers as well as liquidity providers have been participating on securities market because for them they have some incentive which basically cuts down their clearing fees. So this is the impact that we have seen. Right, so overall 3.1 basis point. So what SGX has finally revealed that they have 21 market makers and liquidity providers currently, and then they're seeing quite a bit of a positive increase to market depth as well as liquidity for the 70 qualifying stocks. Right, derivatives revenue is up 3% Q on Q, which was also within expectations as we have seen the China A50 contracts growing quite exponentially in the last quarter. So interim dividends of 4 cents has been proposed. This unchanged from prior year. But so we look over here, sorry for this. This is SDAV, which is the securities daily average traded value by price range. So we look at the breakdown, anything below 20 cents, right? What you're seeing is that the year-on-year wise, it has been down 64%. Right? Whereas for all the traded stocks that's above $5, actually the SDAV has been up 6%. So basically this is the range that SGX is going to eliminate going forward. Right, so they have 3 years to completion for that. So any stocks below 20 cents basically be removed from the main board. Right, so SDAV against market volatility. If you see the market volatility, this is the one that's been driving down SDAV, right, for the last 1 year or so. So for the introduction of the money market, the market makers and liquidity providers, it's a hope that we can drive out the market volatility, right, and also to increase the SDAV consequentially. Right, so now I hand back to Kenneth to talk about Civmec.
Okay, thanks Ben for the update on SGX. Okay, today we're going to talk about Civmec. I'll try to get through this as fast as I can. If I seem to be rushing, it's just only because I want to get through my slides. Any details that you miss out, you can always download our report and read. It's quite comprehensive. Okay, so Civmec, possible growth despite normalizing mining capex. Okay, let's just go into this. Right, here's the company. Here's just a snapshot of the share price. So on Friday, the last time we checked, the price was 73.5 cents. The share price for the last year has been range bound between 67 cents and 81 cents, consolidating. Market cap, well, the forward PE is basically 9.2 times right at today's price. Okay, so what is Civmec? Okay, Civmec is listed on the SGX main board. It's an integrated, multidisciplined construction and engineering service provider to the resource and infrastructure sectors in Australia. Okay, right now its main facilities is on Australia. This company was actually started by James Fitzgerald, who actually started Oz Group or Oz Clad Industries (AGC) in 1988. And he was responsible for the strategic direction for 20 years. Along with Patrick Talon, in July 2009, they started Civmec, and they listed on SGX on April 2012. Okay, Civmec, basically its name suggests what they do. The name comes from amalgamation of civil engineering and mechanical engineering put together. You get Civmec. Okay, so in just 5 years since starting in 2009, revenues have actually grown to 430 Singapore million dollars, and adjusted net earnings is $35 million in end of FY14, which was last June. Okay, they have executed well with net margins historically above 8%, and they have some competitive advantages that include a large seafront main facility in Henderson, excellent internal controls, they call it Civmec, which is a BMS system, and experience management. There's good visibility for next year. FY15 revenues estimated to grow 15% and net earnings to grow 14%. And the strategy going forward is to, which I'll touch on later on, is to increase cross-discipline capabilities, drive more internal efficiencies, and geographical and capabilities expansion through acquisitions or whatnot. Okay, so this is just the blue bars here is basically historical revenue. Orange bars is the forecasted revenue. This is the quarterly one, and this is the annual one. I'll draw your attention to the one on the right, which is the annual one, and you can see essentially that the revenues will be increasing year on year. Okay, let's continue. Company introduction. Here are two key management personnel. This is James Fitzgerald, and this is John Patrick Talon. Okay, I'll let you read more about them in the report. Let's just continue. Both of them actually own roughly 20% of Civmec. And they started this company as well. Okay, here's the corporate overview. They have 3 locations: Henderson, Darwin, Broome. They serve essentially 3 markets: the oil and gas market, mining and infrastructure, and they do they're starting asset management and integrated services. This is still in its infancy. They have basically 8 disciplines: heavy engineering, modular, structural mechanical piping installation (S&P), site civil works, precast concrete, industrial installation, offshore logistics, and maintenance work. Okay, so okay, let's continue. Some information on their geographical nodes. Their main facilities is in Henderson itself, all right, and it's essentially the largest of its kind, and is located at the seafront. So it's sporting a size of 120,000 square meters, and it has waterfront access for larger, more integrated modules. Okay, previously outsourced services are now under one roof, and this will reduce costs and increase Civmec's capabilities. For Darwin and Broome, these are more satellite nodes, which are just a fraction of the size of the main facilities. Okay, they do a few services there, like precast, offshore logistics, and site installation services. They build these nodes to get closer to some of the main project sites. Okay, here's the location on the map. So Henderson, their facility Henderson is down here. Okay, it's in Perth, right? And Broome and Darwin are over here. Okay, the green areas are essentially their major project sites. Okay, at this point, most of them are all in Western Australia. Here's a journey to date. This is their timeline. So just give you a quick taste of their journey. So 2009 July they commenced operations. Since 2009 July they acquired the seafront land. They commenced site civil works over here. They commenced erection of their workshop in April 2010. September 2010 they commenced industrial installation. Here they commenced fabrication. Okay, here's when the workshop officially opened in April 2011. They listed on SGX in April 2012. Here's the commencement of their office development, and it's a really big office. Okay, all this is in anticipation of increasing projects going forward. So December 2012 is commenced of remote site, precast, etc., etc. Okay, what I did was I transported the main timeline, the timeline of the facilities and capabilities onto a revenue map over here. So I've taken the liberty to do this. I think this might give us a bit more appreciation in your journey. So essentially, in the white boxes are the capabilities that they've added over time. Okay, for example, in September 2009, you have site civil works and precast work commencement. January, you have small-scale installation work commencement. Here you have heavy engineering projects commencement, modularization. As you can see, over time, they have sequentially added capabilities, okay, as their revenues increase. The black boxes at the bottom shows the activity of their facilities. For example, October 09, that's when they acquired the Henderson Seaside land. April 10th is when they erected their workshop open. April 12th is when they listed on SGX, raising 40 million. June 13th, here they expanded into Northern Territories, etc., etc. So most recently, they opened their surface treatment facility online, 4,800 meters, and now they're establishing plans for 2,300 meter plant maintenance workshop. Okay, so going forward, as you can see, they are still expanding. Most recent over here, December 13, they commenced delivery of vertically packaged projects, and these are essentially integrated projects that require multiple disciplines, and so this is a testimony of how integrated their capabilities are that they can deliver such projects. Okay, so let's just continue. Let's talk about their competitive advantages first. What's leading to increasing business and above average margins? And their margins are actually above 8%, okay, which is higher than most of their peers. Well, not exhaustive, but we'll give you 3. Large seafront facility. 2, state-of-the-art fully integrated management system. We call it Civmec. And they have a history of strong project finishers with a tendency for innovation. So let's go through one of them bit by bit. We talked about this one already, so let's go forward. Oh dear. Oh, here we go. That was strange. Okay. Large seafront main facility. So this is the 3D view of the Henderson facility. It's actually very, very big. The facility essentially is, if you follow my mouse, it's actually this region over here, at this region over here, and that's their full facility. Now this facility is actually really big. It's 1,200 square meters. It's larger of its kind, and not only is there scale, but it's also 500 meters away from the Australian Maritime Complex, AMC Wharf, which is over here. So only 500 meters away. Okay. Also note that in the facility itself, right, Civmec is still adding facilities within, for example, a subsea workshop. Okay, so why is that a competitive advantage? Well, the scale is one thing, but it's also the largest of its kind next to the seafront. Now, well, something's not. Okay, keyboard. Okay, all right. Now, this is a map of Henderson itself, or Perth, right? And this blue node over here is the AMC Common User Facility, which is the wharf. Okay. This is to show you that similar firms with steelwork or other similar capabilities, right, the closest are actually 9 kilometers away. So Civmec is literally the closest there at 500 meters. So why is this a big deal? Well, for most of these fabricators, right, if they want to collect big components and fabricate next to the wharf, they have to book the common area on the with AMC. So the common area will essentially be this area over here, coupled by some areas over here. So this is the common area. So other fabricators, if they want to use the wharf, they have to book ahead of time. Whereas for Civmec, they don't need to do that. Anytime the component comes in, they can just bring it straight into their facility to work on it. So as you can see, this saves either transportation, but it also saves on coordination risks, because if you have to book these areas ahead of time to work, I mean, there's this risk of what happens if you have a project delay and all of a sudden your scheduling is clashing with other companies. So the seafront facility is a plus. Okay, second, they have a really state-of-the-art integrated BMS or business management system, and they call it Civmec. They've developed this internally for the last couple of years, and they've been very disciplined users of it. So the short of it all is, well, what does it do? Well, it's estimated to be state-of-the-art for heavy engineering companies of this size. It allows real-time monitoring of all works in progress. It monitors man-hours and reports material costs of actual versus planned. It provides integrated and analytical reporting to the project team and clients, and that's a really big plus. Okay, so this basically kind of summarizes what I just said. Now, note that for Civmec, right, I mean, labor and raw materials actually take up 45% of its project costs. So when if you can optimize and manage these resources well, right, you're going to have savings, especially if you have multiple projects. And as you can see, one limiting factor of many of these engineering companies is the ability to accept more projects. Because to accept more projects essentially means you need to have much more project management, or else you're going to lose out on margins and you can't execute well. So this provides a good base for them to increase capacity of projects. So here's just two pictures example of Civmec. So every steel component here are barcoded in specific ways. Okay, every time a worker will come and when they finish their part of the job on the steel component, they will basically scan the component. And so once it's scanned, Civtrack basically records the progress, the man hours and costs incurred. It lets the team know who's supposed to work on it next and who has already worked on it. And this progress can be seen in real time, and it can be seen by clients as well. So a client can actually know in real time at any time what's the progress of the work for them. So that, and this improves you can imagine how this will improve confidence for clients. And this is probably another reason why Civmec's revenues have increased over the years as clients become more confident giving work to them. Now, strong project finishes. Civmec has a history of good, strong project finishes in its 5 years. And here are just some examples. Okay, so one, here's the Acropod precast blocks. What's the key about this? So, well, Civmec delivered over 12,500 precast concrete Acropod 2 blocks. They did it ahead of schedule for the Wheatstone project. But also note that this project is actually the first ever contract for Australian-made units, because usually for these type of concrete precast blocks, they are made by lower cost countries, overseas competition that operate off lower cost base. So this is a testimony of the efficiency of Civmec to be able to win the contract and to be able to deliver these against lower cost based countries. Now, here is number 2 is the single cell tandem iron ore rail car dumper. Okay, first made. So what's so special about this is you can see it's a very massive project. Okay, it has multiple steps and it's the first to be made in Australia. It was delivered in September 2012. So this this is actually Metso's rotary car dumper for Rio Tinto's Cape Lambert Port B expansion. Okay, so the key about this delivery is that this project actually set the worldwide industry standard with the most technologically advanced list of features for system dependability, efficient operation, and long service life. In lieu of this recognition of the high quality project, Civmec and Metso received the Engineering Projects Steel Design Award from the Australian Steel Institute. Okay, and the completion of the design award, okay, for this was followed by actually more contracts for 2 further tandem car dumpers. So this just shows you the quality of the way they do things and the quality of their work. Third one I want to talk about is just this subsea manifold and PLEM, which was awarded in 2011. What's notable about this is that it is subsea. As you know, subsea work has actually higher specifications, and not any service provider can deliver it. So in a span of just roughly 3 years since they did fabrication and subsea manifolds, right, or manifold work, right, they managed to get subsea quality basically. Okay, so that is quite commendable, and this has been and this is 2011, the subsea manifold, and now in August 2014, they've had repeat contracts from Technip, which is another subsea company. So the repeat contracts include for the 2 big LNG projects, the Shell Prelude filling LNG project, and for the Wheatstone LNG project, it includes the building, fabrication, and testing of subsea components such as buckle triggers and suction piles, okay, and subsea jumper spools. Yep. So you can see Civmec has a tendency of strong project finishes, showing a penchant for efficiency and quality, and they've also demonstrated the ability to have subsea capability as well, fabrication capability. Okay, so these are the three. So based on these three, this is probably some of the big reasons why, since the IPO in 2012, they've had an earning CAGR of 7%, with net margins of greater than 8%, which is very respectable, considering the mining capex has dropped since last year. Okay. Note that later on in our comparisons list, peer comparison, you'll note that the highest other 3-year average net margin was 6.5%. Okay. Additionally, FY14's effective tax rate was 22.9%. It's actually lower than 30%. And one of the big reasons why is because of the tax rebates given by the government for innovation. Anytime a new methodology is employed that saves time or resources, the government allows a R&D tax subsidy of 10% of allowable expenditure. And this finds itself in the lower tax rate. Okay, so the investment merits are as follows. We talked about the competitive advantages now. So the ability to generate higher average margins, the competitive advantage with the only seaside facility of its kind in Western Australia. In 5 years, they are shown to sequentially integrate new capabilities over time, including the ability to deliver subsea work, and they're continuing to increase this. Although there is a multi-year cyclical softening on oil and gas and mining capex in Australia, as you might have known. However, the secular resource production is still up. Okay, Australia is still planning to increase their resource exports by 5% CAGR from now till 2025. Now, in addition, okay, there is a new infrastructure growth package that the government has announced this year, and this will actually bolster the declining capex, oil and gas and mining capex in medium term. There's experienced management, and management has already guided that the first half of next year activity will be similar to the second half of last year's financial year. And these numbers were elevated. Based on this guidance, we actually conservatively estimate that this will lead to a 15% revenue and earnings growth for FY15. A quick look at the operational highlights. Okay, the end of FY15 in June marked a few landmarks which bode well for the future. One, Civmec is delivering in the midst of delivering, 3 of Australia's largest oil and gas projects, Gorgon, Wheatstone, and IFAS, okay, which is the first major project win in Northern Territory, okay, showing that Civmec can run with the big boys. Award of vertical integrated contracts involving civil works, precast concrete, fabrication, structural, mechanical, and process piping, electrical, affirms their integrated multidisciplinary capabilities, and they've completed the construction of a 4,800 square meters. Cube purpose specialized surface treatment facility. Okay, and increased their Henderson waterfront facility in Perth to a total of 120,000 meters squared. Okay. Quick look at the operational highlights. You'll see basically that the fourth quarter was vastly exceeded last year's one, and it increased. And it also increased from third quarter by 40%. This is increasing because project work has essentially been ramping up. Projects the gross profits but the gross profits only increased by 20% because margins have lowered because of the bigger project sizes. As Civmec goes for the bigger projects and bigger project sizes, right, the margins for bigger projects are typically lower than the smaller ones. Okay. So here you can see from FY14 to FY15, you can see basically the increase of revenue and EPS increase. Okay. Recent development, I'll skip this. We talked about the repeat contracts from Technip. I think we've talked briefly about the enhancing subsea capabilities by the commencement of the construction of this 1,200 square meter specialist subsea facility. So this bodes well also for the future as they increase their capabilities and facilities. This is just their prolonged strategy. Essentially, it's to increase. Okay, actually, I'll skip this one. Okay, let's look at the group outlook. So the group outlook is very simple. They're going to increase emphasis on the larger value projects for consistent revenue flow. they're going to build up business momentum. They're actually going to increase tendering activities in the construction, maintenance, and oil and gas sector. Civmec believes that they have the capacity in terms of facility and project management capability to actually accept more projects, and hence they're going to be increasing their tendering activities. So there are healthy prospects. You have the emerging opportunity in the oil and gas sector, driven by steady rise in LNG prices, but also an increase in government infrastructure budget. We'll touch on this next section. And they expect business momentum to be they're going to expect business momentum to continue for the next 6 months. Okay, so first half FY 2015 would be similar to the second half of FY 2014. We are right now in first quarter 2015, so we have not seen the revenues yet. This is taken off their Civmec's presentation slides in September themselves. Okay, industry analysis. Okay, we know that the market size for resource projects in Australia, the committed amount of dollars in terms of projects, right, is as follows. The pie is quite big. 507 billion for now. 229 is committed. Okay, about 100 is announced, and 169 is feasible. So committed basically means that the company that is building, or rather the project that's going forward, has already got all the funding that they need, and they've got all the government regulations, and so they're either about to start or in the midst of start. They're already started, and that's how you end up in committed. So you can see the pie is quite big. But let's look at trends. Okay, the outlook is going to be as follows. Let me just skip this one. Okay, so first, oil and gas and mining capex is going to level off. This is not a secret, right? So based on BIS Shrapnel's forecast just last year, essentially oil and gas capex is going to basically drop by about around 8% annually, right? From a peak of 55 billion a year to roughly about 40 billion a year. Okay, mining, it's already taken a drop, right? And it's basically stuck in this consolidation level here. Okay, so for the mining, it's range bound between 32 and 37 billion, and for oil and gas, the drop is about 8% annually. Okay, but we still note that the pie is actually very, very big. It might be dropping off at 8%, but this spike is actually very, very, very high in the first place. So there's actually a lot of capex dollars still going around. The average ONG and mining capex is roughly around 70 billion for the next few years if you just average everything. Okay. However, there's more. Just this year alone, there's been an unprecedented increase in infrastructure spending by the government, announced infrastructure spending. So just this year alone, the Australian government announced the infrastructure growth package over here. What is this? It means that in just this year alone, they're going to add $11.6 billion to basically put into infrastructure investment. This is in addition to what's already been committed here, which was $39 billion to 2019 to 2020. So together, now you have $50 billion worth of Commonwealth government spending. Now this spending, okay, $50 billion, right? That's just the government spending. They are going to be placing it in initiatives which will hopefully catalyze more investment from the state as well as the private sector. So, based on the budget document 2014-2015, okay, building Australia's infrastructure, the government is expecting that this $50 billion of spending will actually catalyze altogether 125 billion. Okay, it's going to catalyze more basically from the private and the public sector. So overall, you get this. Okay, so if you take the 125 billion, okay, before we do that, right, to give you an idea of what the $50 billion is going to be used for, here are just some of the breakdowns. Okay, as you can see, Western Australia is going to have 4.7 billion. A lot of it's going to be on the eastern side. Okay, and here are some of the projects that they are going to do. For example, the Roads Recovery Program is essentially a renovation of many of their major roads. There's a bridge renewal program, that Civmec can take part actually in the roads work and the bridge renewal program, because they can basically provide all the steel work for the new bridges, etc., etc. Okay, but in any case, this, if you take the 50 and the 225 billion, you'll see that if you take it together and average it out, you see that it definitely bolsters the decline of the oil and gas capex, basically. So there is still a lot of infrastructure dollars and oil and gas dollars, mining dollars around for Civmec. For a company of that size, there's definitely enough for them to grow their revenues just by increasing capabilities and facilities. Okay. Third point, the accumulated capex in mining and oil and gas is leading to an increase of operational expense of sustaining capital works. Okay. In other words, the more you build, the more maintenance you will eventually need. And so Civmec is also trying to position themselves in this maintenance market. This maintenance market is actually quite hefty. To give you a perspective, another engineering company was recently awarded an extension of a facilities management service worth 200 million for the Gorgon LNG project, which is over here, okay, in Western Australia. This is just one of many, many projects. So if you just do a simple extrapolation, you realize there are lots of maintenance dollars running around. Here's a forecast by BIS Shrapnel, okay, just updated October of 2013. You can see that the forecast is increase of maintenance dollars annually. So by 2017, there should be about $17 billion annual expenditure of $17 billion on maintenance alone. So so this bodes well if Civmec can successfully develop their maintenance arm, which they're in the infancy of doing so right now. Okay, so conclusion, oil and gas capex declining, but they came from a high base, right? But the increased infrastructure spending plan by the government should augment this by another 10 billion for just the government spending alone, but closer to 25 billion if the $50 billion of government spending catalyzes the 125. Okay, so we feel that these 2 points provide an ample pie size for Civmec to continue their growth plans without being significantly impeded by macro reasons. Okay, now on a longer term basis, the capex spending is going to drift lower, but there's going to be increasing OPEX and sustaining capital, right? And this provides a new bed of opportunities for Civmec. Okay, so valuations. Alright, so we've mentioned this before. We note that the first half 15 average revenue similar to half 14. So you look at this chart over here, orange is the forecasted one. So these 2 quarters here is the first half of the year, of this coming FY15 year. This has been modeled basically at the same average level as the last half of last year. Okay. Then after that, we applied a concession to just be defensive on to account for the probability that there might be a dip in revenues just because of the project cycle. So basically, I'm putting a concession in case there's some project delays, or in case some of the major projects of Civmec don't line up well together. Hence, there's going to be a drop in revenue, because we note that for the major projects, right? Major projects usually take 9 to 15 months to complete, which is roughly a year. And in that year, the initial part of the project has a low revenue contribution. It ramps up a lot in the middle, and then it kind of dies down again towards the end, right? So basically, when a engineering service provider, when they have multiple projects, right, the most ideal case is if they can line up all their projects nicely, such that they overlap nicely, then you get a consistent revenue stream, right? So this is just we're putting in a consensus in case that doesn't line up properly, right? We're being conservative here. Okay, but if this does dip, we definitely expect it to ramp up because of increasing order flow, right? So based on this forecast here, you're going to get an improvement of basically 15% revenue and 14% net earnings. Okay, we just decreased the margins slightly due to increasing size of projects. That being said, we peg it to a forward PE of 10 times, and that implies a target price of 80 cents per share. So based on the current price of 73.5 cents, last time I checked, that's actually an upside of 9.9%, including a 1% dividend, which they'll probably give up. Okay, let's take a look at peers. Okay, looking at peer valuation now, we see basically I put three here: Oz Group, Monadelphous, and Leighton. Now, I will say that Monadelphous and Leighton are not really good comparisons because they're really different. The closest peer is actually Oz Group. Okay, it's the most obvious peer. They're both listed on the SGX. The other two are listed in Australia. Their market caps and capabilities are very similar. Their main facilities are even 9 kilometers from each other in Henderson, right? But this is no surprise considering that James Fitzgerald, who founded Civmec, actually founded Oz Group first. So he left and essentially, carried on doing some similar things, right? But the comparison is made hazy because you can see that Oz Group is actually trading at a PE of 19.9 times, which is very high. Forward PE, that's forward PE. Okay, there is no trading PE. Trading PE is negative because they were loss-making last year. So basically, the comparison is still hazy because AGC was loss-making last year, and at the same time, they're in the midst of a JV with Ezion. Okay, and note that even if you don't look at this year, the last 2 years, their net margins have been subpar at less than 2%. And they've still operated in a similar business climate as Civmec. So in this regard, Civmec is definitely executing way better. So to be conservative, I just ignored the FY14's PE, and I looked at their at 2011, 2013 when they weren't having that bad a problem. And when you did that, you find that their trading and forward PEs were both basically 13 times. So Oz Group, which is the best comparison actually, was trading at a historical 13 times PE. Now, Monadelphous, right, it's harder to make comparisons because Monadelphous is actually listed in Australia. It's got a longer history. It's got 5 times the market cap, more capabilities. And Monadelphous actually has a mature maintenance segment already, whereas Civmec does not have a mature maintenance segment. Geographically, their works are all over Australia with small dealings in Papua New Guinea. So even though they are more matured, okay, and has a matured maintenance arm, but their average net margins have actually been less. And at the same time, right, management has guided that their end of the FY14's revenue is actually going to decline by 10%. Okay, so because we think Civmec has more growth prospects, we believe that at the very least we can peg it to slightly more than Monadelphous. So between Monadelphous and Oz Group, we have 9.7 to 13 times. We think 10 times is very reasonable based on that. Leighton is just there to show you what a blue chip, multidisciplinary, multi-business segment company looks like. It's massively bigger than Oz Group and has a lot more business segments outside of engineering, like building, contract mining as well, and it works in all countries. So you can see that for Leighton, it's trading at a forward PE of 12.2 times with very low net margin. Now the STI forward PE and the Australian ASX 200 and industrial and small industrials are here for your reference. As you can see, they're all trading at 14 to 15 times. So we think that 10 times is basically the lowest measure, which is quite conservative. Okay, so based on that, we have the PE variance chart here. So so assuming that our revenue projection is correct, 0% variance, right? That implies a 10x PE of 80 cents. Now, there is an upside risk because if the activity level for the second half of 15, if it does not dip as much as modeled, if it does not, right, then you could have more revenue. So just to give you a perspective, assuming that it does not dip at all. So let's assume that these levels down here are around the same levels as the first half. If you assume that, then you would actually get essentially $45 million profit or 9 cents per share earnings, and that would imply a 90 cents target price. So that's where you have some upside risk depending on the size of the dip if it happens. Okay, so to end off, let's look at some risks. So upside risks include this. Well, if there are no project delays and there's increased project momentum, right, that will actually lead to higher FY15 revenues. They are planning and they're trying to successfully break into new geographical markets and increase their capabilities through acquisition or internal development. So if this ever happens, that will also be an upside risk. And of course, if they can get into the maintenance market faster than expected, there's upside risk. Downside risk will basically be um, a drop in the future exports of coal, iron ore, and LNG. Okay, because a lot of the project that's going to happen in the future are currently at planning stage, not at construction. So if this drops more than expected, right? I mean, some of the planning projects in planning phase could be delayed. Okay, or there could be a worse than expected drop-off of capex levels for the mining and oil and gas sectors. And of course, there's execution risk, or there's always a chance that the inability to increase project wins. So this would be the downside risks. Okay, so just going forward, okay, short-term Civmec is poised and ready to basically increase their tendering activity, basically to go for the higher value projects for more consistent flow. Okay, and to build up this momentum. On a longer term, they plan to do three things. They plan to continue to increase their capabilities, drive internal efficiencies, and to go for geographical expansion based on acquisitions, etc. Okay, so that's it for Civmec. Thank you, and we'll take some questions now. Okay. Okay, first question is this. What percentage of profit does Henderson facility accounts for? It's probably realistic to say that the Henderson facility, okay, it's hard to, okay, because a lot of their work is also off-site, because they do a lot of project work on-site as well. The Henderson facility is used to basically fabricate a lot of their stuff, but they still do a lot of infrastructure on-site. So if you're talking about fabrication, right, I will say that majority of the fabrication profit is from Henderson. Okay, the dividend for Civmec is estimated to be very small at just 1% because they're still a growing company. Okay, here's another question. Good question. Well, who are their main competitors? Now, for Civmec, right, in terms of comparable peers, their closest peer is most likely Oz Group. In terms of competitors, right, it depends on which they have competitors overseas as well as regionally, based on their different capabilities. So they would have some competitors for steelwork. They would have some competitors for civil work, for example. It's quite numerous basically, so it's hard to pinpoint which ones. In terms of order book, actually they have a very hefty order book at 300 million. I failed to mention. So right now they actually have an order book of $300 million right now, which is basically almost 75% of 1 year's revenue. So it's quite hefty. Okay, labor cost is the main cost component. So based on the labor statistics which I pulled out from the Australian government, right? Labor labor cost is only it's estimated to increase by about 3-4% next year. So it's not a big increase for labor. Here's another good question. What proportion of revenue and profits are from recurrent income? Now, the thing about Civmec is this. Most of their revenues are not from recurrent income. So these are all project works. Okay, that's the reason why they're trying to basically develop their maintenance segment, which will have more recurrent income. So I'll say that the thing about Civmec is that it does not have very much recurrent income. However, in terms of order book and project work coming in, and capex dollars, as we talked about, the environment seems very healthy for them to increase their project work. Okay, I'd like to point out one question here. What differentiates Civmec that allows it to compete with Monadelphous and Layton? Let me just say that when I included Monadelphous and Layton, right, I included it as a peer valuation. Like I wanted to compare their valuations. I would hesitate to call them competitors per se because they're actually quite different. They have some of their works are overlapping, and sometimes Civmec actually does work for Layton, for example, as well. Okay, but they're more in the same industry. But what differentiates Civmec and allows it to compete with Monadelphous is very simple. It's the whole middle half of my presentation, which talks about their competitive advantages. Next question is there any visibility of strong order book going into 2016? The management has not guided what's the order book in 2016. Okay, it's only guided the $300 million order book they have now. And they also guided that first half of FY15 will be at the same elevated levels as second half of 14. However, as you can see, there's actually a lot of capex dollars going around, augmented by the infrastructure growth plan that was just announced only this year. So Civmec, as a civil engineer as well, can partake in the infrastructure works. What contribution to net income is achieved through innovation tax rebates? That can be easily calculated because usual tax rate is 30%, and this year they've had an effective tax rate of 22.9. So you can just take the percentage and multiply it off its profit before tax. Okay, here's one question. Interesting. Do you think it's justifiable for Civmec gross margin to consistently outperform its peer even in the future? I will say that I think it's justifiable that they can outperform their peers still, simply because they have a really good base infrastructure to begin with. See, a lot of times, right, when a engineering project company, when they increase in size, the more projects they have, their margins drop because management becomes very difficult. You see, the more projects they have to manage resources, personnel in different locations, and that provides a lot of problems. So if you have a system that can manage this very well, right, it bodes very well for you. And I think that's the reason why they've internally developed the Civtrack system, and they've been very disciplined users of it. So I will say that once your base is good, when you start spreading out, right, it'll be easier for you. So I think it is justifiable. It's possible that as their projects become larger and larger, their gross margins will probably look a little bit more like their peers, but I still think they will outperform. I mean, a case in point is you could easily compare Civmec to Oz Group, and they have very, very similar capabilities. If you look at their web pages, they offer very similar capabilities, but one of them is operating at 8% net margin and the other one is operating at 2%.
Hi, this is Richard speaking. There's a question on any update for 800 Super. Currently, there's no change in our position on 800 Super, but just want to highlight that it's going ex-dividend next week on the 3rd of November. So if you want to get the dividend, last day is this Friday.
Alright, last two questions. One, Civmec is only listed in SGX, question mark. Yes, Civmec is only listed in SGX, it is not listed in ASX. The reason why Civmec is listed in SGX is because they had a long-term plan of being regional players in Asia Pacific and not just to Australia. And that's the reason why they're listed in SGX. And that's also another reason why we actually gave Civmec a valuation slightly higher than Moneydolphus because Civmec has more growth prospects. Most of their works are essentially in Western Australia. So there are a lot of low-hanging fruits. They can easily tender projects for the rest of Australia if they want to, and also regionally as well. And their maintenance arm is not developed yet. So when it is developed, they can be able to increase their revenues. However, we do note that for the maintenance market, it will probably take some time, maybe even 2 years, for them to really produce significant numbers from maintenance. So we just keep that in view.
I have a question on Keppel Corp. If the drop in prices is due to the price drop in oil, I think largely most of the offshore and marine counters, especially those exposed to the upstream side, been seeing quite a lot of sell down, right, because of the oil price shock that we have seen over the past 2 months. So Keppel Corp most likely the pullout is from funds who are underweighting on the oil and gas sector in general, right? Not just limited to Singapore, but also for the US stocks as well. Yeah, but fundamentally wise, Keppel Corp is still quite sound. The last quarter's results for the offshore side was quite good. The order book is quite strong, visibility going up to 2019, and the margins are very stable as well. Right, just that for Keppel Corp itself, the property arm is not doing that great, right, due to lower home sales in both China and Singapore. Right, thanks.
Okay. All right. Last two questions. Kenneth again. So, can Civmec's free cash flow in operations support capex dividends? Yeah. If you look at our financial projections, right, the cash flow for operations would be enough to account for capex as well as dividend. Okay. And one last one. I think I will talk about this. So the question is this: what differentiates Civmec that allows it to compete with Moneydolphus and Leighton? Okay. Now, this is where the value proposition for Civmec is. Okay, I'm gonna quickly go through it very quickly. Okay, the reason why they've been managing margins higher than the peers is because, one, they have the largest of its kind heavy engineering facility in Western Australia that is at the seafront, 500 meters from the wharf. The next pier is 9 kilometers away. That's a big plus. Second, they have this Civtrack integrated business management that we believe is state of the art. Okay, it is very comprehensive and even allows clients to monitor the progress of their project. Okay, which is very, very key. This basically increases confidence, increases business opportunity as well. And third, right, I showed that they had already a history of strong project finishes. So every strong project finish basically attracts more projects to them. Okay, so I talked about how they managed to do the precast blocks ahead of schedule and beating off overseas competition that operate in lower cost base. The iron ore railcar dumper was award winning, for example, and they even have now subsea capability. So these are the reasons why I wouldn't say they are better, okay, but I'll say allows them to be very competitive versus their peers. Okay, so that being said, I think we will close for now. Thank you for tuning in, and we'll look forward to see you next week.